step one is I'm not all about the returns. I'm all about the risk reward setups, because if you invest, if I told you, I could tell you how to trade the stock market, and every trade you do, it's either going to be either double your money or lose all your money, but you'll win 55% of the time. You're going to lose 45% of your trades, but you'll win 55% of the time. That's priceless.
Yep.
The point is having the right risk reward setup and doing it enough times that you'll consistently make money and grow your wealth over time. And that's got to be the mentality.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I am your host, Chris Grinzik, and with me, as always, is John Cohen. How are we doing, bud?
We're hanging in. We're doing good. No complaints.
Yeah. Do anything fun over the weekend? Any good plans?
No, we did absolutely nothing. It was great.
Sounds like good plans to me.
Drive by a couple open houses to see the idiots buying houses at crazy prices. But other than that, we just hung in there. We got we're nothing, no major plans. Sort of just relaxing, taking it day by day.
Mm-hmm. So that's kind of surprising because I don't know about you when you talk to people, if you see a ton of people just leaving from New York, but I hear about a bunch of people thinking or leaving New York. And it's kind of surprising that you haven't seen any change in housing there yet. Do you have the same feeling or no?
So I know, like, my aunt moved to Florida, at least for, majority of the year. They bought a condo down there. My uncle has a condo down there or a house down there. I know a ton of people that are moving out, but you go to these open houses or drive by them, right? I would never wait 4.5 hours online to get into an open house. That to me makes no sense. Mm-hmm. There's no inventory. So it's a little skewed, right? If you look at, and this is countrywide, in particular to New York, the only reason why the demand is crazy, there's no inventory, right? When a house gets listed, there's so many people looking for houses that, okay, maybe it's 100. Historically, it might have been 200. So many people have left, but there's still so many people for so little houses. So inevitably, I hear more people leaving. I mean, we've even had the conversation, not that it would ever happen, but, I'm online, looking at crazy houses in Montana and, Florida and Tennessee. And I'm looking at crazy things just because, maybe there's a grand vision that I'd love to, but the easy answer is yes. I know of a lot of people leaving here and getting out of New York, but at the same time, because there's so little inventory, there's still an ungodly demand for houses, which is, it is what it is.
Yeah, that just seems crazy. That would scare me if I was looking to buy a house up in New York. That, I don't know. I just feel like it would be like a mini bubble almost.
It's insane. Like, part of me wants to sell my house. Like, I've been looking for rentals. Like, can I rent something and just get out of my house now, right? Because
sure your wife
whether it's worth more, less, or indifferent, I can make a compelling argument that it's only going to go up because of supply and demand and demographics and everything that's going on. But at the same time, you're right. I mean, you're looking at these houses that are historically $500,000, $600,000, $700,000 houses, $850,000, $950,000, $1 million, and you're looking at this. You're like, this is a 4-bedroom, 2-bath, 1,500 square foot Cape, $1.1 million, like unrenovated. It's like, and you go in and you talk to the agents, and all the real estate agents are hysterical, but you go in there and they're like, it needs 50 grand in work. I'm like, 50 grand. I said, the house is falling apart. It's going to cost you 50,000 for a kitchen. Yeah. But, everything needs 50 or 75,000. And then they point to a comp, fully dormered, 5 bedrooms, 4 bathrooms. Like, yeah, don't, 50, 75 grand and you can be that. I'm like, yeah, no, that's not how this works. But you're right. It is scary when you're looking at these houses, because if you look historically, they've never been worth this. It's like, It's like 2007, 2008 on, not even steroids. I'm like steroids on steroids. Cause these houses back then were worth 600, 700. Now they're worth $1 million, but there's such a demand. There's a work from home, thing that's going on, and, people want more space. So I get it. But I think it's a supply and demand thing, not necessarily a bubble thing.
Yeah, for sure. Without going too much further into it, it's interesting you bring that up, because I'm starting to hear more people talking about going back into the offices. Like, I know my sister's going to have to go back in soon permanently. Heard somebody else have to do that too. So it's going to be interesting as more and more vaccines roll out, as things kind of pass by, how that shift back to offices, how much it's going to be and how much that's going to affect decisions people are making in terms of housing.
I'm in the office 3 days a week now.
Oh, you are?
We spent about $4,000 doing a podcast room, and I'm in my house. On Tuesdays, I stay home. Tuesdays and Fridays, I stay home.
You guys were
Monday,
scrapping the
Wednesdays,
office.
Thursdays. I got to get it fixed up and clean. But yeah, no, partially got thrown out of the house by the wife. Slash, we are going back in. I know we spoke about potentially getting rid of the office. We have it for another year, but we're back in the office. I'm unvaccinated. Don is vaccinated. But at the same time, we're that collab. Listen, the human interaction, although if you're a partner and we don't have 100 people that work for us, there's something to be said about that's like a lost element. I feel like, staying home for a year is nuts, right? It's crazy. So, getting out, running into people and back into reality. Listen, are we requiring people to come in? No. Would we ever? No. Did we ever? No. But it is nice to see how that's rolling out and how, what that effect is, in the next 6 months or so.
100%. I'm sure we could keep talking about it. Maybe we'll touch on it more, but I want to bring our guest in because I'm excited to hear him, learn about his story, pick his brain and all that great stuff. So that being said, Dovid, thank you so much for coming on.
Thanks for having me.
Awesome. Did I pronounce that right? Just double checking.
Yeah.
All right,
yeah.
Perfect. So just wanted to make sure. Sometimes I mess it up, but glad I didn't.
That 20-minute session before the show practicing really helped.
Yeah, exactly. So kick us off a little bit. Tell everybody a little bit about, you, your background, all that fun stuff.
All right. So I started professionally in residential mortgages in Israel. I'm based in Israel, which is very different than the residential or any mortgage scene they have in the U.S. It's much more of a service industry, a buyer representative, so to speak. There is no licensing even for it. You just have to go find the banks, work with the banks, and convince the buyers to try to work with you. There's nothing preventing them from even going around your back and taking your terms into another bank. So it's a different kind of industry here. In the course of doing that, I discovered a lot of people who were sitting on anywhere from $50,000 to $200,000 who couldn't afford to buy. The real estate market in Israel, the loan market in Israel, is very different than the U.S. There was a statistic that was published, a chart I saw a couple of years ago, but I think it basically held up, of a number of countries, about 20, 30 different countries, with the amount of months of salary you need in order to purchase the average home based on the average salary. So in the US, it was like 2.5 years of salary purchases the average home. In Israel, we were at like 12.5 years. So the cost of housing here is way out of whack with what people are earning. And especially given the average salaries in this country are also very skewed, because we kind of have two economies here. We have the high-tech economy, and then we have the rest of the economy. So high-tech earns significantly more than other people do, which means there isn't really a lot of people at that average. It's more just two different income tiers. Mm-hmm. So a lot of people who really can't afford, and in addition to that, additionally, mortgages are kind of capped at 70%. Sometimes you get 75% LTV, and you can't finance your closing costs or anything. So you usually got to come up with a good 40% of your purchase price to buy anything to live in, and that really pushes it out. Not to mention the underwriting requirements are very strict here. So a lot of people had money, couldn't afford to buy, and that got me thinking that people needed things to do with that money. I've been actively investing. I've been passively investing for well over 20 years. Back in 2008. I didn't have a lot invested at that point, but I kind of was saying, this is probably a really good time to get started. Mm-hmm. So I started buying stocks in like January of 2009, which is kind of like the perfect time. The market hit bottom in March, and I made a lot of money without really knowing what I was doing for a little while. I missed out on some good opportunities because I really had no clue what I was doing. But I've been investing since then, and I wanted to help people get into do something with their money. I knew you could do something with money. I knew you could earn money passively, and people were just sitting out and keeping it in the bank or putting it into bonds, whatever it was. So I wasn't going to do the stock market for numerous reasons, and I kind of gravitated towards real estate. I've been active in real estate. Real estate is one of the first rules I learned when I started investing actively was you have to understand where your value is coming from. You have to understand where your money is being created from. And this was really driven home. This point was driven home in 2008 when one could argue, I believe, that a large part of what caused that crash was people completely lost sight of the underlying value of what they were trading, which is how the derivatives became such a huge market and completely detached from the underlying mortgages that they were being written against. So real estate is the kind of thing which it's really very, very straightforward and simple in terms of where your value is being derived from. You buy a property, you have rent collected, and it goes into your bank account. It's a very simple business model, as well as the fact that it's probably over the last 100 years, there's probably been no single driver of wealth quite like real estate. I wanted to preach to you guys.
Mhm.
And so I wanted to help people get into real estate. So the real estate market here wasn't really the right market for investing and buying investment properties. The taxes are crazy. The financing is even worse on investment properties. So I kind of gravitated back towards the US. I'd been living in Israel at that point for about 6-7 years, but grew up in the US. I grew up in New Jersey. I lived 10 years in New York. So that's really my where I'm very familiar with. And I started bringing money into multifamily and commercial deals. And that's where the business has grown, where I'm kind of serving as a place to pool capital for diversified real estate investments, quality investments in the commercial multifamily space.
Mhm. Awesome. I love it. I think that's a really interesting story. Curious though, how was there a transition for you from, because you said, the single family mortgages going right into commercial multifamily? Was there a transition there, or was there a pretty quick leap from you from one to the other? And what was that reasoning?
Yeah, that took a while. The idea
Okay.
I was sitting on this concept for a very long time, trying to figure out how to do it, trying to figure out just the right way to the right investment vehicle. What's the business? And then I had to start calling up lawyers and figuring out the legalities. And I deal regularly with both U.S. and Israeli securities law, so I had to have very long conversations, kind of sorting out all that fun, 506B, 506C,
Mhm.
accredited, all that great stuff. Just figuring out legally how it would structure everything. And then there's a question of finding the right partners. My strength at that point was, the residential market here in Israel. I needed to build a network. I needed to find the right partners to work with in the U.S. market. So I'm based in Israel. I wasn't interested in trying to run my own deals. I didn't have the operational background, and frankly, I wasn't looking to become a real estate operator. My goal here is to provide a financial solution for people who could really benefit from it, which is most people, let's be honest,
Mhm.
but people who didn't necessarily know about it and who could be able to take advantage of it if they just had the right people they could trust and had the right deals for them and could be diversified properly. So there was a bit of a long process. There were a couple of it was like any business. It went through a number of phases and pivots, and you start with one person, you try different people out until you kind of find your legs and start churning out good deals and build a larger investor base to really build something.
Mhm.
So there was probably about a 1 year period where I was doing both, and then I kind of phased out of the mortgages into doing this more full time. And then even then, it took time to start. To this day, I have a day job and I have this business that I run, and it's actually been working very well for me in terms of the overlap between what the day job is, as well as it allows me to reinvest more in the business and in the growth of the company.
Mhm. Awesome. So just for, again, a little bit of context, what year did you start raising money for commercial deals in the US?
So our first closing was February of 2017. We
Okay.
closed on, we brought money to it was a retail center in a small little retail center in Tulsa, Oklahoma.
Awesome. And I think one thing that's really interesting that I like asking about people like yourself that aren't actually operating but are looking for operators and maybe have a little bit more savvy and understanding than, the normal passive investor. What are some of the things that you have looked for or you found to be the best indicators of a good operating partner or a good, sponsor, something like that?
That's a great question. We actually just my partner and I work with a guy who's been doing this for 15 years. We actually just sat down a month ago and formalized our sponsor onboarding process in order to
Mhm.
be able to onboard more effectively
Mhm.
and very thoroughly. And some of the most significant pieces we're looking for is first of all, we want transparency. We want people who are very, very good at reporting, who are very clear about what they're doing. That's very important. Anytime people start to, be unclear, they don't want to share the information, even in the smallest ways, that's a big red flag for us. We find that people that focus on I was just talking to one of the guys in my company today about this. There's some people we find who just have. I love working with second or third generation operators. These guys who kind of grew up with real estate around the dinner table. Those kind of guys. They have such it just comes to them so naturally. All those little things that maybe dollars and cents, you wouldn't even think about it. But I'll tell you, we have a deal right now. We have one deal in Broward County in Florida, and we kind of went into it during COVID, and it had all the challenges that any deal, any B- deal would have during COVID. But one piece that's made such a difference is they came in there in the very beginning. They had some space available. They built it's a B- property. We're getting up to B+, but it's still B- at this point. And they built an A+ gym. Really, I looked at it. They showed me videos of it afterwards. It's a really, really nice gym. And you'd think if you're looking for your dollars and cents guy, you'd say your first impression is, okay, so you just spent money on that and it's a nice amenity, but like, where do you get where's the payoff? They have countless, or they have a number, but they have many, many people who just came, and the leasing agent took them straight to the gym, showed it to them. And there are people who signed just after seeing that alone. Like, this is the kind of property you guys have. This is the kind of amenities you're giving us. This is the way you run your operation. We want to be living here. And it's this intangible thing that if you're around long enough, you know to do these things.
Was that I wasn't quite sure. Was that an apartment complex or was that something else?
Yeah, so it was a 400 unit multifamily.
Gotcha. And they really came in, blew up the fitness center, and that drove a lot of the leasing, is what you're saying.
It's driving a tremendous amount of leasing, and it's one of those things that a guy with 5-10 years experience may not pick up on, but if you have a much more broad perspective, you can see it. So we love working with these second, third generation operators, but not exclusively. As I said, the transparency is important. The promotes are important to us. How a person approaches splitting profit. It's a very big window into what their thought process is in terms of how a deal should work. We like to see people who aren't trying to manufacture wins, trying to overly finance, or you want to. The starting point is to buy in the right place. You make your money, like the rule in real estate is make your money on the buy. So you have to find the people who are starting off with that kind of perspective and respect their investors' money.
That's important. I talk about that all the time, right? Anyone can engineer a deal to look good, but real estate is not that difficult, right? Location, and you make money when you buy. The things that we believe in, where we are, I mean, I know Chris knows this same thing is, if you buy it right, your basis is good, you're going to weather storms, you're going to be fine. And how you structure that, when you're buying top of the market, crazy bases or purchase prices, that's when you got to get a little funky and creative. But if you're going in with a fundamentally sound basis, which is what we believe in, which has made it a little bit more challenging for us to buy, we have to get comfortable with, whatever this new basis is. It's important. But on the promote structure, are you guys looking for a certain exit in a certain time frame? Or because, one thing that, a question that we got on one of our deals, we were going to hold it for longer. It was a different structure than we normally put out there. We also have significant capital in the deal ourselves, but taking that off the table, if a operator were to come to you and say, hey, there's a little bit of a longer hold, how do you manage equity multiple, IRR, splits with percentages? What checks off that box for you? And I know it could be deal by deal, operator by operator, but how do you guys approach that situation where it's incentivized for a sponsor to stay in and not just try and, get out on an 18 IRR because you hit a hurdle, but your equity multiple shit?
Right. Yeah. The IRRs are very, they're a very tricky number to work with. Just trying to explain. it's like all these conversations. Everything is discussed on this call, both before I was brought in and after I was brought in. It's like stuff I've been talking about in the last 3 days. Yes, the IRRs are very tricky in that regard.
Mm-hmm.
So, in terms of the promotes and the profit splits, what I'm always looking for is something that makes sense, something that's right, and that shows not just that it's right, but it also has to show that you are thinking about the investor side. So, if I have a deal that's, a 7 or 8 pref with like a 70-30 after return of equity, and the return of equity is done in a fair way, so then at that point, I don't really care how much, what the IRR is or what the multiple is. Obviously, you want the deal to make sense, but those numbers will largely be determined by how aggressively or conservatively you underwrite the deal. I've seen deals that they were originally marketed at like a 14 IRR, and they exited after 3 years with a 40 IRR, like legit, like real, with a 3x multiple.
Mm-hmm.
So a lot of that boils down to the actual operational capacity and savviness of the operator, not so much what numbers you put in the paper in the beginning. Again, it goes back to what we were talking about a minute ago. You buy in a good place. I have a guy, he bought his first time he told me that his property was like it was a 4.5. They're going in cash on cash was 4.5%. They bought as a multifamily in Vegas, and they just, after like a year and a half, they refinanced out 70%. They were making at that point like 20% of the money left in the deal.
Mm-hmm.
And then they got some crazy buyout offer, and they're exiting after 3 years with a 40% IRR, which
Mm-hmm.
is good by any metric. So you buy in the right place, you run the deal right, you get a good buyer, it could work. So it's got to make, so in terms of those numbers, I like to see investor level IRRs. I don't like when people put in their packages, deal level IRRs, because what the investor really cares about is like what they're going to be targeting.
Mm-hmm.
And it's got to make sense. The investor has to get the money back first. The investor has to get a fair return. I don't want any clawbacks and all that stuff. And I need to see in the operating agreement that it reflects itself properly. I once got a guy telling me that he has a 7 pref. It's like, okay, that's fine. Then I get the operating agreement, and the way it was written there was a 7 pref non-cumulative.
Mm-hmm.
Like, oh, okay, that's not what people usually mean. We got him to take it out, but and I let it go because I know this guy. I know this guy very well, and knowing the situation, the guy's lawyer threw it in there, and the guy probably wasn't even aware of it. He's an operational guy. He's not a legal guy. So that was the kind of situation where, if that had been the first time I was seeing a deal from this guy, I probably would have walked. Being that we have a history, yellow flag, and I move forward with him.
Mm-hmm. So I think a lot of people may not know what non-cumulative means on a pref. Can you just explain that quick?
Yeah. So the concept of the pref is you're going to be getting let's say it's 7%. So that means the first 7% of profit in a year goes to the investor side.
Mm-hmm.
Oh, by the way, I should add it was 7% non-cumulative with a catch-up. Let me just make it even better.
Gotcha.
So what that all means is, so 7% pref means the first 7% of the profit goes to the investor side. So let's say the deal is $1 million. The investor put $1 million in the deal. So the first $70,000 generated that year after operating expenses, debt servicing, goes to the investor. Now, what happens if a deal doesn't have profit in a given year, right? We just had this with COVID. A lot of deals had their cash flow dry up. So what happens with that 7%? So in a normal pref, if you don't add those words non-cumulative, or you put the word cumulative in there, it means that 7% carries over to the next year. So now the investor side, the LPs are owed that $70,000 from the previous year. So that means that they're going to get going into the next year, they'll get the next $140,000 of profit before you start the profit split, before you start the promote. When you put non-cumulative, once the year ends, your 7% ends, and you have to start over again the next year. So you don't want that. I mean,
mm-hmm.
the baseline of pref, the basic theory of the preferred return and why it's so nice is, I'm putting my money at risk. I'm trusting you, and the sponsor side always stands to make very good profit
mm-hmm.
on what they're doing, but I'm trusting you with my money, and I want to know that I'm going to get something out of that, or at least the first tier of profit, the first baseline of profit should come to me.
Mm-hmm.
And by saying that you're going to give me a pref 7-8%, whatever it may be, you're acknowledging that fact, and you're saying that even if the deal doesn't produce over a couple of years, at the very least, at the very end, when you sell the property, if there's profit there, we're going to give you your money back first, and we're going to give you back your profit first. We're going to give you the first tranche of profits. So,
mm-hmm. Yeah, No, I think you bring up a good point, because there's always a disconnect between what you see, what somebody says, what somebody puts in a marketing book, marketing deck, an investor deck, and then what actually ends up in the, legal files, the PPM, all that stuff. So it's always really important to, know what it is, but really understand what's actually physically in the documents, because like you said, it could just be the lawyer doing it. It could be they decided to change their mind. It could be they don't fully understand the differences and they're just saying it's a pref, but it's not really pref. Like one time I saw a deck that said, in the deck too, not even in the legal documents, it said 8% pref. But then when you go down to it, it was really a 90-10 split up to 8%. I'm like, that's not the preferred return. That's wrong. It's just labeled wrong. I mean, if you want to do that, you can, but don't call it a preferred return. So just really understanding that what people say and what's actually in the legal documents is super, super important, because it can change. And it may just be an error, right? A lot of times lawyers are working on, different companies' deals, and maybe they use somebody else's document as the baseline for your document and they miss something. It doesn't have to be a nefarious reason, but it is just important to look through it, every single time, as well as, look through beforehand. Like I know that's one of the things, at Toro we always provided was, all the example documents from past deals so that people could look through it and ask questions beforehand and, have a little bit of time. So it's not like, hey, we're raising money and you feel under the gun to, commit, read the documents, fund, and do all that stuff. You can kind of just glance through it and make sure all the boxes are checked, type of thing.
100%. I mean, that's part of our process. We underwrite new sponsors, is we actually get from them deals that are more than a year old, and we get from them both the original the marketing package, as well as the operating agreements that were signed, so we can check and make sure that there's consistency there.
Yeah,
because that's an area that really differentiates the the men from the boys.
So you touched on something interesting too. You said, the numbers on paper, the investor level IRR matters, but it doesn't really matter because it depends basically how they operate it after they take over. You gave the example of the deal that went really well. I'm sure by now you probably had a deal that didn't go so well as you thought. So how do you feel out somebody before you actually do a deal with them of their operational capabilities? Because if we're saying, hey, look, a budget is always going to be wrong. Hopefully you're wrong to the upside and not the downside, but you're never going to put, if you put $50,000 for, taxes, it'll probably be like $50,000 and $100, right? That's not a big deal, but you're never going to be right on, right? So how do you then look at that, but then get a better feeling from the actual ability of the person running the deal, that hopefully that number just gets better, every time or most of the time?
Yes, that's a question we've been asking ourselves a lot, because especially we're dealing with other people's money. It's not like we can just say, well, we'll put a couple 100,000 here, 100,000 there, test people out. So what we've done internally is we sat down and spent a lot of time creating a very thorough questionnaire. We don't make anyone fill it out. We just kind of go through it conversationally over 2 Zoom calls. And we have a whole review process on the past deals that I alluded to before. But we ask a lot of the questions around what people do with the property. Do you walk the property? What kind of stuff do you look after in the property? What's important in a property? You have an extra $50,000. What do you do with it? Kind of gives us a sense of where their mind is at, from an asset management standpoint. We're trying to get at, just kind of teasel out all those little pieces of information to see if they have that added. It's really hard to quantify. When I started this process, I really wanted to create some sort of very simple quantifiable process, like with a scoring system, but I haven't gotten there yet. It's a lot of it is, but it's having those conversations, hearing how they talk about it, getting through all these questions, and just seeing that they have the operational on the ground capacity. How often do you visit properties? If you're very cavalier about using on-site management, and we'll check it out every 6 months. Okay, that's one level of operation. Another level of operation is, we have an on-site manager who's there every day, and we're there every 6 to 8 weeks. We're on the ground there. That's a very different level of operational seriousness. When it comes to commercial, we have questions that are, you have to go deep. Like one question we ask for our retail operators is, which national tenants, which national companies do you have relationships with? stuff like that. If you've been around for 15, 20 years, you should have relationships with some companies already. Let's see who you're working with. Let's see who you can bring into a property. Stuff like that. You got to find ways to figure out every aspect of running a deal and ask questions that indicate if a person really has the ability to, or at least the knowledge to run it or not. That's obviously not going to indicate to us that they're responsible enough, but hopefully that's another reason we check out the narratives they produce. One thing we ask for in those deals, in addition to the operating agreement, in addition to the loan terms that were signed, the loan documents, are all the narratives, quarterly narratives that are sent out. Are you issuing a one-page little summary, or do you provide a full budget of what's been going on? How much information do you give to your investors without them asking for it? How much do you give to them if they do ask for it? The more you have, the more experience you have, and the more you understand, and the more experienced investors you're used to dealing with, the more you're going to be producing, and the more we can see how well you operated based on your original targets.
So for, multifamily, because it's, I don't really know retail or anything, so we'll just focus there. What are some of the things you want to see on those, quarterly updates from your operators? Like, what are, if you had to bullet point out, 3, 5, 7, whatever those things are, what are the most important things for you to see without having to ask for them?
I like to see, I want to know in detail what's happening with leasing and renovation activity in detail. I like a full quarterly expense report, like line item, everything that's been, where all the money's been going. I want to know, are you spending on marketing, are you spending on leasing, or where all the money's going. I like to know sometimes the little details. I like to see, like when you highlight, like I mentioned before, the gym. I like to know, are we, what are we doing to maintain our curbside appeal? Little things like that. What type of upgrades are we doing? What type of maintenance are we doing? The more details I get, the better it is. I'm not talking about a 50-page book. We're talking,
Sure.
What are we talking about? We're talking about a 200, 300,000 unit thing. There's not gonna be that much information there, but I want to know what's happening on the property, and every little detail matters, because people choose to live in places based on these details.
Yeah, I think one of the things that people forget is, for multifamilies, that you are providing a service in housing, and there's a big thing of like, the marketing stuff is nice, right? And especially with a lot of people moving, interstate now, a lot of people are doing sight unseen. But I think your best operators are probably paying attention to those things and probably seeing significantly less turnover, because people's expectations for when they're moving in are more closely matched than they move in. They're like, oh, well, this thing sucks and this thing sucks, and I thought this and I thought that. Once you kind of have those expectations that aren't what you were thinking, there's probably a high likelihood that they're going to be, more upset, which could lead to a higher likelihood of leaving. It could be that, it's not, the things aren't that big of a deal, and they're like, oh, I would have been okay with this for the most part, but there's a higher probability that that's not going to be the case. And I got to imagine now, especially with the rise of technology, the rise of e-leasing and, video tours, and people feeling more comfortable with technology and not seeing the specific unit before they move in, that there's going to be a greater gulf between what people's expectations are and what they actually walk into. And I wouldn't be shocked if the people that meet those expectations well are going to see a lot better, returns, lower expenses, higher income because of, that turnover piece.
Yeah, I'll even add to that. What we're finding in our better properties is one of the best sources of quality tenants are our existing tenant base. If you have people moving in and they're the kind of people you want, and they love where they're living, they'll rave about it to their friends, and they'll bring their friends there. So having tenants love the place they're living is just, it's really good business, and it really impacts the bottom line.
No, for sure. I mean, it's been funny. The first property I closed on, I've had like probably one person a month reach out and be like, hey, I got your number from so-and-so. I know there's vacant units. Can I move in? And we've been doing pretty deep renovations, so haven't had anything available for lease yet. But I was like, wow, that's kind of cool. Like, that whole process of like, coming in, people appreciating, you're doing, happy with it, and willing to recommend it to other people. It's pretty interesting to see that play out, because it's tough when, like Toro, where we weren't handling the day-to-day management, it's tough to know whether that's really happening or not from your property managers, because there's only so much detail you can go into on every single one, but being more in the weeds and hearing that has been pretty interesting.
Right.
On our weekly calls, on the weekly call, basically the first question that I like to talk about it drives whether we need a new leasing agent or not, right? Are you asking these questions like where, can we track that information? Because you're right, your appearance and the way you handle situations and maintenance calls and visual, those are the things that are intangibles that make major results to your P&Ls, because your leasing is great, your closing ratio is great, where the leads coming from, are they just that's super important. And we've seen it where you have a couple of slower weeks, and next thing you know, 2 weeks later, the leasing agent, new leasing agent, right? And you can make those switches relatively quickly early on in the business plan. But when you find the right person and the right on-site physical presence that's there daily, I mean, it's night and day, the difference to operation. So your first couple months, especially if you're inheriting something or taking over something, there's a transition period. And then, when you find that sweet spot, that's sort of when it all, everything seems to go significantly better.
I hear that. Yeah, definitely seen that happen.
So how are you guys looking at the whole work from home trend, the different changes in migration, like coming from less of a, the operator side and more of like, hey, we invest with operators. So maybe you're a little less tied to certain areas or certain ideas where maybe you have a little bit more flexibility to change. You could find new operators to partner with that are doing things that you like. Are you guys thinking about things differently over the past several months? Have you guys changed your strategy at all? What are you guys thinking about?
Right. So that's a great question. There are a couple of pieces to touch on there. So in terms of work from home, this is something which I was thinking about very early on, because I mentioned I have a day job. In that day job, the company is set up as a work from home company. We have a base of operation in Jerusalem. We have an office there, and you can work from home. The company set up, you can work from home. So at that point, I before COVID, I'm a 30-minute bus ride to the office, door to door. I can do this whole in 35 minutes. It's really not a bad commute. And then COVID hit, and I wasn't going anywhere. And I was thinking about we have money in a number of office deals. And my first thoughts, and I think that's very back in March, April of last year, and I was thinking that everyone was talking about changing everything. Everyone's gonna work from home now, and I'm like, I know work from home. I've done work from home before. I used to work from a room off of my main room in my house, with my kids running around out the door and right outside, and nobody wants to work from home. People want to work in an office. You want to go out. You want to see people, as John was talking about before. You want to have a water cooler conversation. You want to get out. From a company perspective, from a corporate perspective, there's a certain culture you can build when you're face to face and in person. You can't build remotely.
Mm-hmm.
I discovered Zoom. I was using Zoom 3-4 years ago. That's how far ahead of the curve I was.
Mm-hmm.
And I was trying to drag people onto these Zoom calls because I discovered that having these video calls was like 85 to 90% as effective as meeting face to face. If I could cut out an hour drive to meet a client and meet them on Zoom, save me a ton of time. But nobody had tried this thing where you're on Zoom for 12 hours or 12 hours a day,
Mm-hmm.
without any formal starting stopping time. It had been never tried before. And what I kind of thought early on, and then since then I've seen a lot of people a lot smarter than me kind of echoing, but they've been saying it independently, is people, it's not that they don't like, that people don't want to work from home. They just don't want to commute.
Yes.
And therefore, the big winner, I think, in this is going to be suburban office.
Mm-hmm.
I think we're going to have a lot more of, instead of it being those major urban offices with 1,000 employees in one place, you can have these little like WeWork, take 50 seats in an office somewhere. And so the people who live in this community will go to this remote office, and that community will go to that remote office. Everyone has that office feeling, but you're a 15-minute, 20-minute drive from your house. So you get out of your house, you have your work, you have your home, you have your coworkers, and you don't have to schlep into the city for 90 minutes a day.
Mm-hmm.
So I think suburban office is going to be a big winner in this. All of our office centers over the course of COVID did just fine. We have one center that we had to suspend distributions, and our major issue we had with that center was not COVID related at all. The rest of our centers, the collection stayed constant. Those are all suburban, and I mean, leasing activity has kind of been slow and been on hold, but that's picking up now. But in terms of that, I think office is still trying to find its feet and try to. I don't know for sure where it's going to end up, and I think what John was mentioning before. I think we're seeing a resurgence in the city, in the urban areas. And I was just listening to a webinar this morning about it. That at the end of the day, there's some people who want to live urban. There's some people who want to live suburban. Suburban obviously has been a big winner in this situation. Especially if you're working from home, you want that extra space that the suburbia offers. At the same time, there are people who want urban, and New York is bouncing back. Those urban centers are bouncing back. We'll have to see how quickly and how far it goes. But I think right now the challenges they're facing are not at all COVID related. They're just policy related, and policy can be turned around on a dime if that happens. But so that, I'm a big fan of suburban office. I love suburban office deals, and then those are my thoughts on the work from home situation. In terms of the broader trends, where we're looking now, I mean, you guys alluded to it also. Multifamily is in a very interesting place right now. Cap rates are hyper compressed, and they're getting tighter. It's crazy how tight they're being wound up. One of my biggest concerns is that, and this is already like a 3 to 5 year horizon. This is not any time in the near future. But as interest rates start to tick up, or when they really tick up, because whatever, the interest move a point or two, I don't think it's gonna have a huge impact on cap rates. But when it starts impacting the cap rates, if you move from a move from a 3 to a 5 is much more significant than a move from a 6 to an 8. Right. So I think in certain ways, stuff like office and retail these days has a certain conservative element to it that multifamily doesn't have. So I still like multifamily, and the right deals are still good deals, and there's still the market's on fire. But I think retail has a lot going for it right now. Yeah, again, it's got to be the right deal, it's got to be the right operator, it's got to be the right everything. But I think retail is pretty beaten up right now, and people are really, really bearish on it. I think that creates a very interesting opportunity because, I mean, household savings right now are like $4 trillion more than what they were tracked to be 2 years ago. People are sitting on so much money between all this government, all this government transfer of wealth, as well as the fact that during COVID, people were afraid to spend. People are just sitting on so much money, and that's going to go into consumption. And people are dying to get out of their houses. And that's where retail comes in. We're not talking about, it's like going to department stores to go shopping, but we are talking about eating out, going for different experiences. Movies are going to probably see some resurgence. The retailers were already beginning to modify the types of stores they had in their centers, become more experiential. I think we'll see a continued push into there. As people want to get out and do more, there'll be more experiences offered to people. More businesses are going to be opening. So I think there's an interesting opportunity there, which we're very excited about. And we're looking for those kind of opportunities. And then industrial is industrial. You can't. It's hard to go wrong with that.
Yeah. Well, I was having a conversation with somebody about, the expansion of cap rates when you buy versus when you sell, right? You hear everybody say, 10 basis points for every year that you hold it, right? It's kind of like the rule of thumb. I said, well, people have been saying that for so long, and cap rates were, 5, 6, 7, 8, they were much higher, 10, 15 years ago. And I was like, 10 basis points on a 7 cap is a much lower percentage than, 10 basis points on a 4 cap. So I was like, they were an active and passive investor. I was like, do you think that, that rule of thumb should be lowered? And he was like, no, because nobody's gonna, it's like saying the same thing about, treasuries, right? They go down 25 basis points. They're not saying it goes down 25 basis points on 50. It's people just talk about the number itself. And whether it's right or wrong, nobody really pays attention to the actual percentages of cap rate movements, right? People aren't talking about, well, it's, 25 basis points down on a 5 cap or 25 basis points down on a 6 cap. It's just 25 basis points, and nobody really takes that difference into account. So it's pretty interesting to hear you bring it up, because it's, as like you said, as cap rates get lower, you go, moving from 4 to 4.25 versus 5 to 5.25 is, you're losing less value in that second scenario than the first one. And I think, people don't really recognize that. And unfortunately, nobody's going to, no buyer is going to be like, well, it's a, it's a lower percentage. So, I can, instead of 25 basis points, I'll go 20. I don't think people are going to think like that. So it's really interesting that you bring that up too.
Yeah. Yeah. No,
That's I was going to say that's the argument. I've seen deals come out and their stress test exit is at a 4.5 cap or 4.6 cap, and I said exactly that point is that shit hit the fan scenario on a 4 cap is a lot worse than shit hit the fan on a 7 cap, because 7 to 10 is like a 4 to 5. Just percentage points. I know I'm exaggerating a little bit, but that's the thing that I don't think the average Joe. And the unfortunate side of it, I agree. I'm not talking about 12, 24 months, 36, 48, 3 to 5 years, until the average bear, average investor gets absolutely smoked. There's not a pain point that's going to be experienced, but you can't buy a 3 cap deal. I mean, it was funny enough, we started looking in New York recently because I've been seeing 6, 7, 8 caps, true 6, 7, 8 caps, not broker pro forma. And you're looking at that, when was the last time you were able to buy a real 8 cap deal in New York? Now, I wouldn't put debt on it. I'd expect 2 years of no income, just going super conservative, but you got to feel good about an 8 cap basis in New York, right? If you're in the right location, right situation. So, but your oh shit scenario is, okay, an 8 cap in New York, all cash, I'm making 8% or whatever. Your oh shit scenario, when you have 70% LTV and 10% pref and you have all these levers pulled, your margin of error is a lot less. And when you start having one thing go wrong and then the wheels start breaking, that's when the deal falls apart. When you have that built-in flexibility and a couple things can go wrong and it's not doomsday, that's a scenario that, we'll see what happens. I hope it doesn't. That just makes the multifamily world interesting. I agree. I think some of those other product classes are going to be very intriguing. We've always been the group when everyone's zigging, we want to zag. So we want to be a little bit different, but understanding, the risks that come with that. But I think it's great. More people have to talk about it, and not enough people do. So I applaud you for bringing up the percentage change, not just the increase in cap rate.
Yeah. Yeah. And also I think on that score, I think as people, I'm looking at numbers here, people are still very bullish multifamily, people are still very afraid of retail, but what happens when multifamily gets to 2.5? At some point, money's going to start shifting into these other asset classes and driving down those cap rates, which means there's a lot of value to be had there as well.
Correct.
But I mean, look, a lot of it also depends on your perspective. And if you're coming at this as a long-term real estate professional, your attitude is going to be, so, okay, I don't care. My 4 cap goes to an 8. I don't care. I still have my rents in place. I haven't lost my rents. I'll just hold it. I don't care. But these LP guys, a lot of them coming in with a 3 to 5 year horizon, that's going to blow them up. That's not their plan. And even if you don't lose their money over 20 years, you're going to ruin a lot of relationships because these guys really are expecting to get their money out at some point in the near future. And you can't refinance at that point. You can't do anything. It's got to sit and hold tight.
Yep. Yeah. Your transactional guys are the guys that are going to be, are they in the real estate business or are they in the capital raising, trying to do deal business? Because it's 2 different models. And like you said, what happens when loans come due and they are unrefinanceable, or all the situations, but you never underwrite for cap rate compression. But when you're going into these other products, office, retail, whatever it may be, you would never underwrite for cap rates to come down. But you're right, as more money chases multifamily and cap rates continue to come down or they stay low, then the money starts going into other areas, and that's what drives grand slam returns, because you buy it at an 8 cap, the income's up, and you sell it at a 6 cap, right? Just a regular graph.
Oh my gosh, yeah, that's
ridiculous wealth.
Yeah.
But that's the interesting thing that'll happen, because Wall Street, and I know we had a guy on our podcast, Property Radar. I forgot his name. It's a recent episode. I apologize, but with the amount of capital that Wall Street has raised, they're not going into retail off the box, right? They were raising money for doomsday. Doomsday didn't happen. They're not going to give the money back. So they're going to be coming into the residential space, whether it's single family, new construction, multifamily. That's only going to drive prices up, cap rates down. So if you're in that space, you're going to benefit if you own stuff. Although, who knows what's going to happen with the proposals on the tax changes. That's a whole nother conversation. But
Yeah.
there's going to be a benefit. So zigging a little bit now while everybody's zagging, I think will be beneficial as long as you have the stomach for that and your investors understand that. And the biggest thing, going in eyes wide open.
Yeah. Look, that's what we diversify. We went into this. We have right now. We don't have any industrial. We got rid of our. We had very little industrial to date. But going into COVID, we had residential, we had multifamily, we had retail, we had office, and ironically, our best performing asset class across our portfolio, which again, is not a significant sample size, was the office. Our multifamily deals were all B minus, B plus conversions at the beginning of the cycle, and we had a huge problem with each property at the 10% delinquency with tenants who were taking unfair advantage of the eviction moratorium. Retail obviously went through what retail went through. We held all our properties, but we couldn't keep up distributions. Office did great. The idea there is you do want to be spread out because you don't really know what's going to be. To me, the biggest, probably one of my greatest aha moments in investing in general was when I realized that the way to be successful is to assume that you don't know what's going to happen. And you start off trying to figure out, I'm going to figure out what's going to happen, and then I'll be successful because I'll figure out what's going to happen. I'll predict it. As soon as I realized, like, no, you're not supposed to figure out what's going to happen. You're supposed to position yourself to be able to absorb the shocks that you know are coming but don't know what they are. That's when you're going to be successful, which is why our whole modus operandi is to help people diversify, because we don't know where the winds are going to be. I've been saying since I started this thing four plus years ago, I've been very afraid of what's going to break multifamily. Now, I don't know what it's going to be. I have a couple guesses what it may be, but and maybe nothing will break it. I don't know, but is it inconceivable the multifamily gets hit by some sort of systemic shock and it jumps from a 3 to a 5 or a 4 to a 7? It's not inconceivable. Nobody's thinking about it, but it's possible. Now I know a lot of people I say this to, it turns them off, like you're just crazy. But I'm not saying it's going to happen, and I'm still investing in multifamily. I think it's a great asset class, but if we're not thinking about these questions, I think we're exposing ourselves to more of these type of risk scenarios that we hadn't thought of. Like one scenario that I like to play out is 3D printed housing. What that does from a price perspective, I ran numbers on this. I'm talking about back of napkin calculations, but what it does in terms of opening up new areas for development and lowering the cost of housing and making land that wasn't available to be built on now available to be built on. It changes the whole calculation start to finish. Autonomous vehicles. Think about your 45-minute commute, how much easier it would be if you could sit in the back seat and work as opposed to having to drive. All of a sudden, you don't have to live as close to where you were before. So you taking 3D printed housing, autonomous vehicles, and now we already have the whole telecommuting thing just got accelerated. That could have an impact. I don't know. I'm not hedging my bets in terms of not buying multifamily now, but I think we need to be thinking in these terms, just to be prepared for that, which is why we're diversifying and why we're just keeping our eyes open on all those different fields.
That's a very interesting point, because we've seen crazy things. The last year sort of allowed people to, I'm going to go move to, a cabin in the woods, and I'm productive. Oh, and I don't have to pay, I go to the cabin in the woods in Tennessee, pay no state income tax, and earn what I earned in New York City. I'm down for this. Or I can go have a 20-acre piece of property with, a beautiful lake and mountains and no neighbors and, a fraction of the price in taxes. So those are things that are real, right? And my brother actually sent me an article last night. It's like my vision of 2030. And it spoke about exactly what you spoke about, autonomous cars. And now listen, 2030 maybe quickly, maybe too quick, but if those things slowly come together, you're right. Where can you develop? Where can you live? Where does the geographic, the country, where do people want to go or spend time in, which will generate, different feels to urban, suburban, rural, those things are all real. So I think, the way you looked at it is awesome, right? Knowing what you don't know and not trying to predict the future, right? I joke around saying I'm not nearly smart enough to, project population growth into certain areas. So I don't, I either got to change my underwriting or change what I do. But what I do know is that if I diversify properly and accordingly, maybe I lose here, but I have a major win here. And, as long as you understand that you're going to win the whole game, you might just, might lose a couple battles, but you're not in it for the battle. You're in it for the war. So
Exactly.
I think that's amazing. And I think it's,
Yeah, no, that's right on the money. That's what I tell my investors. They always ask me like, what's your setup? Like, what are your returns? Like, look, for step one is I'm not all about the returns. I'm all about the risk reward setups. Because if you invest, if I told you, I could tell you how to trade the stock market, and every trade you do, it's either going to be either double your money or lose all your money, but you'll win 55% of the time. You're going to lose 45% of your trades, but you'll win 55% of the time. That's priceless.
Yep.
The point is having the right risk reward setup and doing it enough times that you'll consistently make money and grow your wealth over time. And that's got to be the mentality.
100%.
Awesome. I love it. I think that's a great place to wrap up. So, Dovid, thank you so much for coming on and sharing your thoughts, opinions, experience, etc. If people want to learn more about you, get in touch with you, connect with you, where can they do all that stuff?
Okay, so I'm on LinkedIn, very active on LinkedIn. My name is spelled Dovid, Dovid Preil. I have a website, ydlpinvestments.com. My podcast, where I talk more about general wealth building strategies, is the thinkwealthypodcast.com. And that's about it for now.
All right, awesome. Guys, definitely go check all that stuff out and connect with him on LinkedIn. And thank you guys so much for listening to this episode of the podcast. If you're not already subscribed, it would mean the world to John and I if you would do so. And if you are, please send it to someone that would get a tremendous amount of value from this episode. Dovid, once again, thank you so much for coming on. This is amazing.
Thanks for having me. Appreciate it. This is great.